Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
But one of the first things I wanted to ask you guys, because I noticed you both have red cords on your microphone. Does Morningstar give headsets to you guys?
Yes. How'd you guess?
Yeah. Right. Very on brand with the red cord.
Yeah. Welcome to another episode of Trends with Benefits. My guests today are Erin Lash and Damien Conover. Erin is the Director of Consumer Equity Research, and Damien is the Director of Healthcare Equity Research. And I think these are two important sectors in the U.S. economy, both covering things that people consume and people need in terms of healthcare. Maybe not quite in that order all the time, but I think there are two important things for not only investors but for just individuals as a whole. Erin, Damien, thank you for joining me.
Thanks for having us.
With the markets the way they've been in 2022, just kind of curious, kind of what your overall take of the market has been and what you're looking forward to, and even going into 2023. Maybe just kind of briefly, high level. I'll start with Erin. Kind of what's been your take? How would you characterize the market, and in particular the sector that you analyze?
Yeah, so I analyze consumer product companies, and I would say that they have performed quite well over, in aggregate. There still are pockets of value. And I think that that's, what's really important to disaggregate is where there still is differentiation between our assessment of intrinsic value and what the market is assigning to those names. And our Moat analysis, in terms of digging in and unpacking where and to what extent firms have a competitive advantage, enables us and gives us a greater ability to help us forecast those cash flows and ultimately determine what that valuation is. So we would view the sector, consumer products, as relatively fairly valued, with a handful of names that have been performing exceptionally well, trading at a premium to our valuation, but then some that might have a little bit more hair, but still offer significant value as looking quite attractive at present.
When you talk about consumer, we're talking what a lot of us know as consumer discretionary, consumer staples, right?
Yep, exactly. And I cover household and personal care and packaged food names specifically.
Fantastic. Okay. Damien, the healthcare sector jumped to the fore and everybody's quite aware of it, particularly with COVID. How about you? How would you characterize the sector today?
Yeah, it's interesting. I think when you see the market pull back, a lot of people look to healthcare as a defensive space. And I think that's largely been the case, especially within the biopharma space over this year. We've seen those names do pretty well on a relative basis. But I think importantly, picking up on what Erin said, the thing that really helps us with valuation is looking at the economic moat, which helps us to look through cycles on the market. So as the market goes up and down, what really grounds us is looking at whether or not a firm has a competitive advantage. And that enables us to do valuation work that we think will hold up for a very long period of time. And with that differentiated view, it helps guide our valuation. And we do see a lot of really attractive valuations in the current market, but you do have to be selective, and you do need to be thinking through that lens from our perspective.
Yeah, you both mentioned valuation, which is one of my favorite words these days when it comes to the market. But one might look at the market, the downturn in the market that we have. As of today, I guess we're recording this in November. Anyway, maybe it reached the depths of just over 20% on a downturn broadly. People might look at that and go, look, this is a great time to buy. They might even go individual sector by sector and go, look at the PEs. They're cheap relative to some history, or they're cheap relative to another sector. What do you mean by valuation? Maybe, Damien, I'll hand that over to you to start out with. But do you look at it in that sense, or maybe you can elucidate more about the Morningstar valuation approach?
Yeah, great question. When we think about valuation, we do a lot of our work primarily focused on discounted cash flows. So we'll project what we think the cash flows from each firm would be, And that's guided by our Moat work. So when we think about a firm, if we think there is a competitive advantage that endures for a long period of time, we'll project stronger returns over the cost of capital for that firm. And that has a lot of implications, both on how much cash flow the firm will generate in the near term, as well as in perpetuity. And when we think about valuations relative to historical past, we will start to think about things on some sorts of multiple basis, but all of our fair values are driven by discounted cash flow metrics. And when we do think about valuations from a historical perspective in healthcare, a lot of areas do look particularly attractive. So biopharma, for example, is trading on a relative discount to its historical average. And we think that's a great opportunity for investors to take a look at the sector.
Erin, how about you? Is it the same process across sectors?
Yes, we at Morningstar employ a very consistent process across sectors and across geographic regions. And so I think that that's one of the things that makes us unique, not only in terms of our valuation work, but also in terms of our moat analysis and how we're assigning moats. That's not taking place in a silo. There's a significant amount of collaboration and vetting that goes on across the department to ensure that we're thinking about the sources of competitive advantage consistently, essentially. And just to build off of what Damien said, when we're thinking about valuation, utilizing our discounted cash flow to come up with a fair value estimate, we're not suggesting to investors that they should necessarily, build a position at that fair value. We're thinking about the certainty or lack thereof in terms of our ability to forecast those cash flows and assigning an uncertainty rating. And we suggest that the more steady, consistent operators on my list, I would throw out a name like Hershey or like McCormick, where they, tend to operate very, with a relatively low level of cyclicality. We wouldn't require as much of a margin of safety before recommending that name. Compare that to a name like Beyond Meat, where there's a significant amount of volatility and a lack of certainty in forecasting those cash flows, and we'd require a much larger margin of safety.
You guys talked about the process, and one of the things I love about the Morningstar approach is the process that all the analysts follow. Is there any room for art? And so, if you will, does an analyst have some room to make a call?
I would say absolutely. To be fair, I've been doing this job for the past 2 decades, and I've been covering the same list for about 15 years now. And I still feel incredibly excited and challenged every day because I'm not going to know everything there is to know about the companies that I cover. And there's always different ways to substantiate and triangulate my forecast to try to unpack, where potential areas of differentiation. I would say, while we use the same model and the same approach, each of the drivers and the factors that underpin our model are completely unique to that particular business, maybe to that sector. And so there's a lot of flexibility and bandwidth to really dig in and make sure that we're thinking about this as thoroughly as possible.
And one thing I might layer in, building off what Erin said, I've always thought of the accounting and the modeling, or the actual model is the science of what we do, and the art is the finance and the assumptions that we put into the model. So it's kind of the blending of science and art that hopefully gets us to exactly what Erin said, a triangulation of where we think the valuation should be.
And then you take your picks or you take your analysis, you go to a committee, is it the Moat committee, and make your pitch for what? For the valuation that you're pinning on it for a certain rating?
For the actual moat.
For the
So
moat,
whether
okay.
we're assigning a wide, a narrow, or a no economic moat, but not just the moat, I would say that it goes even deeper than that. It's the qualitative and quantitative analysis that drive the sources of competitive advantage, and we can talk about those further. But that's really what we're trying to dig into and make sure that we're applying that seamlessly across the department.
You mentioned sources of moat. And there are different sources of competitive advantage or moat for different companies that you guys identify. I want to start going into some of the sectors that you guys cover. Damien, maybe I'll start with you. just briefly, kind of high level, what are some of the most prevalent sources of moat in the healthcare space?
Yeah, so within healthcare, there's really two key buckets. One is intangible assets, and the other is switching costs. And just to unpack that a little bit more, in the intangible assets, it's much more focused on patents. So most of the things we'll see with competitive advantage within healthcare are areas of innovation. It could be drug development, it could be device development, but these innovations are patent protected, and it enables very strong pricing power for a long period of time. That's probably one of the most prevalent areas within healthcare. And then a secondary one is switching costs, and that really has to do with getting a particular healthcare product into the system. It can be very hard to leave that product because of the learning curve. So those are probably the two highest areas of focus within healthcare.
Great. And Erin, how about yourself and consumer?
Yes, very similar to Damien. We're thinking about intangible assets, but from a different lane, right? We're thinking about brands and how that translates into pricing power for a particular business. And then also, we're thinking about a firm's ability to entrench themselves with their retail partners. So, are they a valued partner such that they're maintaining ideal shelf space? And that could be in a physical brick or mortar outlet, or that could be online in one of those first page or two of a set of search results. Beyond intangible assets, we're looking at cost advantage to a large extent. So, is a firm able to leverage the scale that it has both with its suppliers as well as with its retail partners to be able to negotiate a higher price and or produce something at a lower cost than its competitive set?
Well, let's continue on with your sector, Erin. As you talk about cost advantage, people, companies dealing with inflation, dealing with supply chain problems, how have the companies actually performed this year, given those headwinds? How was earnings season?
Yeah, it's a great question. And I would say that earnings season, given the vast array of challenges that these firms are up against, I would say the names on my list have been performing quite well in this environment. Inflationary headwinds, are incredibly broad and deep right now, and no one is immune. And I think that that's one of the things that has made this so challenging. But firms are employing a number of different levers to try to offset those headwinds. So, price is obviously the most notable and the most visible. Most of the firms on my list have raised prices at the shelf 3 to 4 times and are expecting that inflationary headwinds are poised to persist into next year. And as such, are foreshadowing additional price increases to come. But the increases that they've taken haven't offset the headwinds that they're facing. And we have seen margin degradation, but they're also looking for cost savings, right? They're also looking to drive efficiencies across their business. They're altering pack sizes. They're reducing discretionary spend. So there's a number of different levers that we've seen firms pull to try to offset those headwinds. And as a result, we've seen pretty sizable organic top line revenue growth that has been met with modest declines in terms of operating margins. So, relatively sound performance given the challenges that are out there.
And do you think that's sustainable for these companies? Do they still have enough give in that lever to continue making those changes or those modifications to their business? And can consumers continue to absorb the increase in prices?
Yeah, it's a great question. So, as it pertains to cost savings and the ability to drive efficiencies, I definitely think that that is feasible for a number of these names. Whether that's automating different systems within their business, their manufacturing and distribution network, whether that is reducing the number of suppliers that they work with, maybe even the marketing groups that they work with, employing different processes to ensure the agility and the speed of their innovation cycle is stepped up. I think all of those things can help unlock savings for the business. As it pertains to the consumer, though, I think that's the biggest question mark at present. The consumer is under a significant amount of strain in terms of the cost pressures that they're facing at the store, at the pump, and then also with rising interest rates. Up until this point, the consumer has shown that they are incredibly resilient. The degree of pricing that we're seeing, which in some instances is north of double digits, has been met with just low single-digit retractions in volume and or volume growth, which is incredibly impressive given the degree of pricing that we're seeing. To the extent that that continues and we see the unemployment rate step up, that could imply that consumers are under even more strain and might not be able to absorb the cost increases that they're seeing at the shelf. And thus, maybe they trade down or out of some of the categories that my firms are participating in.
What are a couple of the sectors or segments within the space that you are really excited about that you're looking at?
In terms of my own list, I personally find Kraft Heinz as well as Clorox as being quite attractive at present. Both had been names that not too long ago were actually favorites within the market and now have fallen out of favor. Kraft Heinz because they had pulled back on spending behind their brands. Clorox because of the degradation that they've seen as it pertains to gross margins. And our take is that those stand to improve over time despite the inflationary headwinds that they're facing at present. And so we'd point to both of those as being quite attractive while also offering attractive dividend yields.
Does that advantage of theirs come from a brand strength?
Clorox's definitely comes from brand strength. If you think about the categories in which Clorox plays, it's usually them as well as private label. And Clorox has done an incredibly good job year in and year out of bringing to market products that resonate with consumer trends. And this has manifested in Clorox being able to command a 20 to 30% premium over private label and not realize much in the way of volume elasticity. And that is evidenced in terms of the outsized market share positions that they've been able to hold over many, many decades.
Yeah, it's something like a 60% market share in a pretty commoditized market.
Yes, bleach is incredibly commoditized. Kingsford charcoal would be another brand that falls in that same vein. Trash bags, ranch dressing, their portfolio is quite disparate. But despite that, they've been able to, command that price premium and to keep consumers coming back because of the quality and because of the innovation that they bring to market.
In terms of consumer names for potential recession, what should an investor look for if they think that next year we might see a recession? They're interested in the consumer space. What characteristics would you look for?
Yeah, I think the most important thing, and Damien brought this up a bit earlier, but is those businesses that are still focused on the long term and aren't making changes to their strategic roadmap based on the near-term challenges that we're seeing. And I think Clorox fits the bill incredibly well in this regard. If you think about over a longer-term horizon, Clorox is historically, and this is back to 2002, gross margins have averaged 43, 44%, holding an incredibly tight band, 41 to 46%. Despite that, this past year, which ended at the end of June, they reported gross margins that were less than 36%. So significant erosion as it pertains to gross margins. But even in the face of those challenges, the company continues to funnel significant resources towards enhancing their digital capabilities, towards investing in an ERP system, towards investing in manufacturing and distribution assets and automating processes throughout the organization. So it's not just focused on recouping that profitability in the short term, but thinking about when we get out of the current landscape, what and how do they need to be positioned to make sure that they continue to win with consumers and make sure that they are still a valued partner to retailers. And so I think that that's key, and monitoring those investments, whether that's in terms of looking at marketing spend as a percent of sales, R&D spend as a percent of sales, CapEx spend as a percent of sales. I think that can help investors make sure that firms aren't prioritizing the short term at the expense of the long term.
Some of these are big names that you've mentioned. Can investors expect dividends from these names? Are these mature names that they can use in their equity income portfolio?
Absolutely. Most of the names on my list do pay a fairly attractive dividend that they have continued to grow. I would say payouts have historically been from 40 to 60% of earnings, and dividend yields in some cases are 3 to 4% or more. So incredibly attractive businesses, and that's because of the cash flows that they generate on a yearly basis. And so we expect that prioritizing and driving and enhancing those returns to shareholders will remain a top capital allocation priority for a lot of the consumer defensive names that I cover.
And Damien, to bring you back in, I assume maybe the answer to that question is a little different for you, or is that a wrong assumption? Are they more, these healthcare companies, pharma companies, more growth oriented?
Well, what's interesting about, you think about biopharma, there's a more of a blend between growth and dividend. So we think the dividend yields in the space look pretty attractive. The average for big biopharma is around 3%. And then the underlying growth rates for this group are close to 8%. So, your total return perspective on this group is, I'd say in the middle area, but it's an area where I'd say it's not completely not growing, but not one of the very high growth areas that you might see in other areas.
You highlighted innovation at the outset of our call. Who are some of the innovators in the space that you're watching?
Yeah, so when we think about healthcare and innovation, a lot of it is in the biopharma space because they almost have to reinvent themselves every 20 years because that's about the length of a patent. And once you lose that exclusivity, you've got to be reinvesting those cash flows to bring out the next generation of drugs. So we really see revolutionary innovation in biopharma. In some of the other industries within healthcare areas like devices, tool companies, it's much more evolutionary, slight enhancements, things that are helpful and enables pricing power, but not quite as radically game-changing as what we see in biopharma.
What if you could talk a little bit about Biogen? They've had a fairly successful run with their Alzheimer's drug trials. Can you tell me a little bit about that?
Yeah, Biogen has just done something really phenomenal. They've been able to bring a drug through clinical development in Alzheimer's disease to show a clinical, meaningful efficacy benefit. That's really unusual because Alzheimer's disease is something that's so complicated that the scientific community really hasn't been able to crack the code there. So for us to have this data that looks very beneficial, it's probably going to translate into an approval of a new drug that will enable very strong rapid uptake and very strong pricing power. When we think about innovation within the drug space, there tends to be waves of innovation. If you look back, 20 years ago, the wave of innovation really was cardiovascular disease. Lots of new drugs out there for cholesterol, high blood pressure. And then you saw the wave start to move into cancer drugs. All sorts of different cancer drugs that are really prolonging survival. And now we think we're just at the beginning of the wave of innovation in neurology. And we think Biogen might be leading that wave.
How do you value a company like such as Biogen, where the efficacy of their treatment is not known right away?
Yeah, exactly. So we kind of know some things about the drug. We know kind of how it works. We know some of the side effects. And we know a bit about the patient population that it's going to be targeting. But then from an analytical perspective, we have to start using those data points to sort of think about what will be the actual patient size of the folks actually taking the drug. What will be the price of the drug? And what's the probability of approval in the different regulatory areas of the world? And so we try to triangulate based on the clinical data, based on historical examples, and that gets us to a rampway that we think is likely. And usually there's going to be slight deviation. We're rarely 100% accurate, but we directionally try to get it right based on those data points.
So VanEck has a couple different products that cover biotech and pharma. What's the difference? Sometimes I feel like they're merging.
That's a great question. I think they're merging as well. So historically, biotech would have been drugs that were actually living organisms and that would be modified and used as a treatment. And that's still how they're technically defined. But the thing where we're seeing the merger is that if you look at a company like Johnson & Johnson, traditionally thought of as a pharmaceutical firm as well as a diversified healthcare company, it is morphing into more of a biotech firm in the sense that a lot of its key treatments right now are biologic in nature. And the pharmaceutical firms that historically were just chemicals, those chemicals are starting to be employed by a lot of the leading biotech firms, like a company like Gilead, for example, which has always been thought of as more biotech. A lot of its key molecules are chemically defined. So I'd say there's definitely a merger of biotech and pharma coming together. And so I generally think about it as biopharma now rather than biotech and pharma.
During the pandemic, everybody started hearing about mRNA. How important is that now to these companies? Or is it, because it was also something that was just kind of on the shelf for a while, wasn't it?
Yeah, mRNA technology is incredibly important for the COVID vaccines. Really the leadership there when you think about the different vaccine options out there. And it was on the shelf for a long time, very long time. But what was remarkable about the COVID pandemic was just how quickly some of these pharmaceutical firms were able to utilize that technology to bring forward vaccines that were highly effective with very little side effect. And so that a huge windfall for these firms as well as for society. And going forward, I think there will be some potential to use this technology in other vaccines. I think the low-hanging fruit is to move into other respiratory areas, things like RSV, flu. I think those will be pivots that will be pretty likely for mRNA. There is sort of the holy grail out there, which is a cancer vaccine that could use mRNA technology. That's a reach. If it works, it's going to be a massive home run. But a lot of times when you swing for the fences, you strike out.
Now, you've mentioned medical devices a couple times, and I wonder if you can get me over the hump. Every time I think about medical devices, I think hardware. I think not really sexy necessarily in terms of an investment story, but maybe you can change my mind a little bit about that.
Yeah, good question. And there's sort of different definitions of devices. You've got, tools. Those are things that tend to work on the outside of the body, different mechanisms to help with surgery and things like that. And then you have devices which generally are thought of as things that potentially can go in the body. So this would be like coronary stents, orthopedic hip and knees, things that can be replaced when the normal hip or knee starts to wear out. And these tools and devices are really becoming very, very important. And I'd say starting to move into some more innovative areas, things like robotics, data collection, things that can really help outcomes for physicians and patients.
What are a couple companies that you find particularly interesting right now, either from a valuation standpoint or innovation standpoint?
Yeah, I think there's a couple that look particularly interesting to us. I'd say one of the names that we really like right now is Gilead. Gilead is a firm that has been very well positioned historically in HIV development of drugs and still is, but is starting to pivot into oncology. And the oncology wave that I was talking about earlier is still continuing. And what we're seeing is a lot of cancers that once be thought of as, oh, that's lung cancer. Then as science progresses, it's non-small cell lung cancer. And then as science progresses, it's ALK mutated non-small cell lung cancer. And the reason why that's important is when you can start to focus on the right subsegments of cancer, you can increase the efficacy of drugs. And that's what Gilead's trying to do with some of its new drugs that are focused on subsets. And because the pricing power is so strong, you don't need the massive amount of patients there. You just need good pricing, good efficacy to really allow innovation to happen and have that benefit both the patients and the companies.
Erin, let me bring you back. As I think about going into 2023, I think about the state of the economy. I guess one of the questions I had for you for your sector in the event that we go into recession, is it fair to approach it as maybe that's an opportunity to invest in the big box kind of value chain companies? Maybe it's like a Walmart or a Dollar Tree or something of that sort versus the luxury retailers.
Yeah, I would say, right up till now, we don't view defensive retail as being an attractive area from a valuation perspective, just given, I think, given the fact that the market probably appreciates that they are going to be beneficiaries in that type of environment.
So they've already been bid up a little bit.
Yes. But up until this point, what we've seen in terms of what we're hearing as it pertains to consumer shopping patterns is that they really are bifurcating. And by that, I mean, you have a specific cohort of consumers that are looking for much higher value. So they are going to your big box retailers, to your club stores, and buying huge value pack sizes of toilet paper and tissue and potato chips, whatever the case may be. But then you have this other cohort of consumers that's really much more focused on lowering their daily, weekly, monthly spend on an absolute dollar basis. And so the retailers that would be most affected by that would obviously be the dollar stores, drugstores, convenience stores. They're winning too. Even though a consumer is probably paying a higher premium for those products, it's meeting their needs. There's a little bit of a mixed story in terms of what consumers are being impacted by this. Campbell Soup has been talking since this summer about the fact that baby boomers are the ones that have been most impacted thus far and are trading down, for large part because they're on a fixed budget. Most other consumer product companies have been talking about the fact that this has been isolated as it pertains to lower income consumers. But we're hearing whisperings that maybe this is spreading across income demographics. And it's not just the wealth or lack thereof, right? It's the perception of wealth. So, to the extent that this isn't impacting the stock market as much, that could mean that that luxury spending holds better than what you would see. So, during the Great Recession, 2007, 2009 timeframe, the stock market obviously, there was a bunch of upheaval in the stock market, and that caused the perception of wealth to decline. And so we saw a pullback in luxury spending at that point. So I think that there's a lot of underpinnings in terms of what's actually happening to wages, to savings, employment, and then what's also happening in terms of investors' portfolios and how that's spreading.
Part of that question was, for me, was trying to get a sense of if there's opportunities for some smaller cap names. It's, I don't know if you see that now in the market, maybe because things have pulled back a little bit. Do you see opportunities for smaller cap names potentially even going into 2023 recession or what have you?
Yeah, I do think that there's opportunities for smaller cap names and not necessarily just for investors, I would say. But I do think that they're, smaller cap names, as we were talking about, or these smaller niche operators within the consumer product space are the ones that have historically proven more agile. They're more in touch and have a better pulse as it pertains to the consumer and what the consumer is looking for. Now, this hasn't been lost on major leading brands. And thus, that's where a lot of the acquisition pipeline has been focused, is in acquiring these smaller names. And so we've seen that be a focus across both the packaged food as well as the household and personal care name. But because of the investments that they're making, because of the breakdown as it pertains to needing to get distribution in leading retail outlets and the cost and time it takes to do so, the role and the increased penetration and adoption that we've seen from e-commerce, I think opens that door much more for a lot of these smaller cap names than even what we had pre-COVID.
As we start to round out the episode here, one of the questions I like to ask guests is about trends generally. And this is an opportunity for you to either talk about a trend in your own space that you cover or anything else top of mind that you might be interested in. So what's one long-term trend you see playing out over the next several years?
Yeah, long-term trend. I really think that as it pertains to long-term trend, we're thinking about innovation and all that encompasses. That really is what underpins economic moats in the consumer product space. And so making sure that there is an outsized emphasis on getting in front of consumer trends, I think is the biggest long-term trend, and all that is wrapped within that. All of that, I think, is going to remain top of mind and really drive the space and separate those that are competitively advantaged from those that could come under increased competitive pressure over the next several years.
So now we are in our trend or fad segment. This is where I'll mention a few different concepts, and you can just quickly mention trend or fad, or feel free to explain if you'd like to. The first one to answer wins each round. No, but feel free to. You can both opine. All right, let's get this started. Buy now, pay later.
Fad. I'm going to say fad.
Interesting. Spinoffs, trend or fad?
I'm going to say trend on this. It's something we've seen in healthcare happen for many, many years. And there's still a lot of different conglomerate structures out there that I think are probably not fully optimized. So I think spinoffs continue.
I'm actually going to disagree, and I'm going to go fad just to be on the opposite side of the coin. I feel like within the consumer product space, this has ebbed and flowed. So while we've been in a period where there has been much more of a focus on streamlining businesses and spinning off those that are non-core, we've also seen that flip in the past, and empire building conglomerates have been more in favor. So longer cycle, but we could get back to that at some point if firms feel it necessary to really juice their growth profile, particularly as some of the current demand environment subsides.
Alternative protein, trend or fad?
I think that's a trend.
Me too. I don't have a ton of insights. Erin knows the space better, but it seems like a trend.
Tech and retail names into healthcare. I'm thinking of like the Amazon One Medical tie-up.
I'd say trend, but it's going to be a slow trend. Healthcare's so hard to get into. It'll happen, but I think it's going to take a lot longer than what most people think.
Well, this is great. Erin, Damien, I really appreciate your time. This is fun.
Absolutely. Yeah.
Yeah, absolutely. Great questions.
Yes. Thank you very much.
Thank you for tuning in to another episode of Trends with Benefits.